even the biggest Fed apologists, they're going to go, oh God, what just happened is irrefutably happening because they have to support the Treasury market to the detriment of what that might do to inflation. And I think whatever that announcement moment is, I think you see the stock market rip to the upside. I think you see gold rip to the upside. Long-term rates actually probably stabilize and even fall because for the moment, long-term treasuries are acting like risk-on assets, not risk-off assets.
Luke Gromen, founder of FFTT. It is so great to welcome you to the show. Thank you so much for taking the time, Luke.
Absolutely. Thanks for having me on, Julie. I'm excited to be here.
Well, I'm excited to have you on because I've wanted to have you on for a long time now. And you are someone who puts out some incredible research on the macro space, and you're really adept at connecting the dots. So I'd like to start where I always start with my guests, Luke, and that is to get their big picture macro view. And one of the things about this show is you can take as much time as you'd like to set the table, if you will.
Yeah, thank you. For me, the macro view, I think, is fairly simple, I think. But I think it's going to be very volatile in that simplicity. So 2000, we had a stock bubble. It burst. Policymakers kicked the problem upstairs to the to the banking system by creating a housing bubble. We had a housing bubble. It burst. They kicked the problem upstairs to the sovereign debt level by backstopping banks and a whole lot of other things. And so now we have a sovereign debt bubble and it's bursting. And so I think for 2024, the real key, the real outlook is that this, I think, is going to be the year where consensus starts to realize that the Fed has a shadow third mandate, which is Treasury market functioning, and that they can only tighten until the Treasury market starts to dysfunction. And once it starts to dysfunction, they inject more liquidity. They broadly, Fed, Treasury, U.S. policymakers, there's a number of ways they can do that. There's a number of ways they have repeatedly done that since in the last 15 to 18 months. We've already seen this play out 3 or 4 times. And so as consensus realizes that the Fed is no longer focused solely on its traditional mandate, so growth and inflation, employment and inflation, and instead is being dominated, those two traditional Fed mandates that have governed Fed policy, monetary policy over the last 40 years, pretty much everyone who's active today's career, most of their career or their entire career, they're going to realize that we're in a situation of fiscal dominance, which is to say the Fed's shadow third mandate, the Treasury market functioning, is dominating and will continue to dominate the traditional dual mandate. And as consensus realizes that here, I think in the first half of 2024, they're going to realize that into a situation where we have almost $6 trillion sitting in money market funds, and we have still a very significant overweight positioning in long-term U.S. Treasury bonds. There's basically positioning on for a recession. And I think there's not going to be a recession. I think there's going to be much more dollar liquidity this year out of fiscal necessity.
Okay, this is fascinating. And there's so many different threads I'd love to pull on. You brought up fiscal dominance. I had Dr. Charles Calamiris on back in December discussing a paper he published with the St. Louis Fed on fiscal dominance. So it's a topic that I'm really interested in. Can we explore some of the implications if we get into a fiscal dominance scenario? What are some of the implications we might see? It maybe things like related to higher inflation. Can we just tease that out a bit?
Absolutely. So Charles Calamiris he's brilliant. That white paper you cited was one of the materials we have written about repeatedly for clients in the second half of last year. Great white paper. I'd encourage listeners to track it down. It's publicly available on the St. Louis Fed website. One of the things he said in that paper was essentially that given the current U.S. fiscal position, debt and fiscal deficits, which are right now running in the 7 to 8% of GDP range, debt to GDP of 120%. he wrote in that paper in June of last year, once U.S. real rates hit 2%, it's going to quickly put the U.S. into fiscal dominance. And what was really interesting is that the U.S. hit positive 2% real rates right at the end of July, early August, and the bond market promptly threw up on itself. You started to see the Fed lose the long end. We had this surprising increase in long rates that was spun solely as an increase in term premiums, which was only partly true. So I think we've already started to see the symptoms of that fiscal dominance. And to me, the easiest way to think about fiscal dominance is that once a country's fiscal position gets into a point where positive real rates sets off a debt spiral, where essentially they can't afford their interest and interest-like obligations without printing money, that's fiscal dominance. And the United States has been in fiscal dominance at varying times already for the past, since the COVID crisis, really. They've been in and out of fiscal dominance. They were in fiscal dominance in the first half, late 2020, where the way we define that number is what we call true interest expense, which is just entitlement pay-goes, the current portion of what they owe for entitlements, because entitlements are just the interest on the $100 trillion off-balance sheet liability that we owe boomers, et cetera, and then the gross interest expense. And so if we look at that true interest expense relative to tax receipts, that number was more than tax receipts in 2020. The Fed printed money. Into 2021, they continued to run stimulus, QE and stimulus. The way we got out of fiscal dominance was paradoxically the inflation and the asset inflation the Fed's been fighting. So by the end of 2021, early 2022, true interest expense peaked at around 110% of tax receipts. It was back down to like 80, 90% of tax receipts. So all of a sudden we're back out of fiscal dominance by virtue of what was essentially QE, fiscal stimulus, a version of yield curve control, but QE and fiscal stimulus at the same time to drive inflation to 8%, while the Fed was keeping interest rates well below that 8% inflation. And they were able to get out of fiscal dominance. Fast forward through 2022 into 2023, the Fed's rate hikes put us right back into fiscal dominance by the end of last year. Real rates hit 2% in late July, early August of 2023, and the bond market promptly started dysfunctioning. We saw a 20%, nearly 20% crash in the most important market in the world, long-term Treasury bonds, in a single quarter. And so everyone's been looking. There's this great quote by Phil Knight, former CEO of Nike, around 2000. And he said, everyone's looking for the next Michael Jordan on the basketball court, but he's walking up the fairway. And he was talking about how they had just signed Tiger Woods, who was going to be the next Michael Jordan, but everyone was looking for who the next Michael Jordan was going to be on the basketball court. Last year, in the second half of the year, everyone was looking for the next crash in stocks or in commodities or in housing. But the Treasury market crashed because the U.S. is already in fiscal dominance thanks to what the Fed did. So I think it's a critical white paper, a critical observation Calamira said. And the reason it's so critical is that it means that the hard landing isn't going to come in stocks. It will coincidentally, but it will come in Treasuries. And at a time when you've got an election, you got 70 million boomers who want their entitlements. You've got a new Cold War. You've got hot proxy wars in at least one, maybe two places. There's no way they're going to cut defense and entitlements to make room for interest. They have to print the money. So it's such a critical dynamic, this fiscal dominance concept that Calamira wrote about last year, and I think really launched into the broader consciousness, including for us.
Yeah. Okay. So we'll definitely link that in the show notes for folks. You said earlier that the consensus is going to wake up to this, or they'll start to recognize this. What do you think is going to make them realize that?
It's hard to know ahead of time what specific event, but I think it's going to have to be something that really kind of punches them in the face, so to speak. So, even over the last weekend, right? Lori Logan, who used to run, she's the head of the Dallas Fed. She used to run the New York Fed's markets desk. She's a plumber. She understands the plumbing. She comes out and says, well, maybe we have to slow down QT a little. And it immediately launches this debate of, oh my gosh, they're slowing down QT with GDP still strong, unemployment still low, inflation still above target. And there's still this other side of the argument that you can see all over FinTwit and on CBC, et cetera. Well, yeah, but she also said that if things get hotter, then we have to keep doing what we're doing. And so the Fed, on a messaging standpoint, is still doing a very good job of what I've called riding two horses with one ass, right? Well, we have to ease QT. We have to slow the pace of QT. Well, of course they do, because they're in fiscal dominance. They have a problem. They need a weaker dollar. But we're also still going to be responsible Fed. Well, you can't be both. And so I think there's a moment coming, and I don't know what that moment is, where it becomes irrefutable to even the biggest, I'm going to call them Fed support. Like, I support the Fed. I understand what they're trying to do. So, but even the biggest Fed apologists that are sort of like always, hey, the Fed's right, they know what they're doing, it's all true. Those people, which I still think is consensus, which is they're acting in terms of their inflation, their traditional dual mandate, they're going to go, oh God, what just happened is irrefutably happening because they have to support the Treasury market to the detriment of what that might do to inflation. And I think whatever that announcement moment is, I think is when you see, I think you see the stock market rip to the upside. I think you see gold rip to the upside. I think you see rates probably, long-term rates actually probably stabilize, even fall, because for the moment, long-term treasuries are acting like risk-on assets, not risk-off assets, which is a little bit of the fiscal dominance dynamic as well. But I don't know what that moment is. I'll know it when I see it, and we'll all see it, because people will be saying, well, wait a second, why'd the Fed do that if inflation's still here and GDP's still here and unemployment's still here? And why is the S&P up 10% this week? And why is gold at 2,500? And why is Bitcoin at 60,000? And why is oil up $5? It's going to be one of those types of aha moments.
But okay, so if you saw those assets move in that direction, wouldn't people interpret that like, wow, this is a great thing. Stocks are ripping. My gold is up. Bitcoin's up. Wouldn't people mistake that as something as a positive?
I think most people, yeah. I think pretty much that's part of the beauty of it is there's not going to be many people going, oh, this stinks, everything's going up. Until 2 months later, and inflation has reprinted at, whatever it is now, 2.75 or 3.1. Oh gosh, inflation's rising again. Now what do you do? But I think there are a lot of, there's nearly $6 trillion sitting in money market funds, because it is sure the owners of those nearly $6 trillion, or 25% of GDP almost, they are sure that the Fed is not going to do that. The reason why you're seeing sentiment on long-term treasuries at the highest coming into this year in decades is because that money is sure that the Fed is not going to do that. And my point is based on what I'm seeing in the fiscal situation, based on the points that Calamiris has made, that money's wrong and has to go to the other side of the boat, which is stocks, gold, oil, Bitcoin, sort of everything else but the dollar. That basically the fiscal situation is acute enough now that the Fed is going to have to make that decision to sacrifice inflation again, sacrifice the dollar again in order to keep the Treasury market functioning. And that is what I think is the big variant perception as we sit here in early January this year.
Hey there, I hope that you are enjoying this interview. If you can, please take a moment to hit the like button, subscribe to the channel, and ring the notification bell. This will keep you up to date with all of our new interviews, and it will also help us grow this channel and continue to bring some amazing guests. Thank you so much for your support, and enjoy the rest of the interview. I also want to just hear more on this idea that you're not expecting a recession, correct, in 2024? Can we hear more on that thesis there?
Yeah. So full disclosure, I thought we were going to get a recession late. So I guess late. I thought it was inevitability through probably through much of 2022, even into early 2023, although we did pivot when we saw Treasury run down TGA and weaken the dollar, because the dollar is really the key linchpin in this. You weaken the dollar, that buys you time. So we saw them weaken the dollar end of 2022 and 2023, but I still thought it was an inevitability. And probably beginning in mid first quarter of last year and certainly into the second quarter, what the MMT or modern monetary theory purists were highlighting, people like Warren Mosler, I started seeing that and it hit me. It was like, oh gosh, they're right, which was when you raise rates radically or aggressively on 34 trillion in debt, what you do is you increase fiscal deficits dramatically, and increasing fiscal deficits dramatically is simply not recessionary. It is very stimulative. And so once you start looking at the world through that lens, you realize, gosh, the hard landing, if it comes, can only come one way, which is Treasury market dysfunctions and breaks. You start to see, and then number one, and then number two, the Fed stands aside, Treasury stands aside and lets it break. And they do nothing while they let the system burn to the ground, because Treasury is the risk-free asset underpinning all other assets. So if Treasury yields are rising into a recession or into a slowdown, and it drives more selling from the banks, sending rates higher, driving more selling from foreigners, sending rates higher, and all of a sudden the U.S. government can't fund itself, and the Fed still stands aside, and they start slashing defense, and they start slashing entitlements, and then we start having Hoovervilles around the country. You can get a hard landing still if the Fed and the Treasury simply stand aside as the Treasury market breaks. And we saw the Treasury market break in late 2022, 3Q22, and they weakened the dollar. They didn't let it break. More importantly, in 1Q23, we saw a hard landing. The start of a hard landing was Signature Valley Bank, Silicon Valley Bank. Yes, it was a bank problem. In quotes, it was a Treasury market problem. These banks, by regulatory push or by choice, had loaded up on Treasuries at 5,000-year low interest rates, and they were upside down, and they were insolvent. And so, if we wanted a recession, if Powell wanted to be Volcker, if we wanted the hard landing to continue, it was very simple. When Signature Valley or Silicon Valley, it comes in and says, "Uh-oh, we're upside down. What do we do on these treasuries? We need liquidity." The Fed says, "You bought them, you sell them. You like them at 1%, dump them at 5, dump them at 4." And now all of a sudden that puts upward pressure on rates, and it triggers Treasury selling from other banks. Bank of America is another one. Second biggest bank in the country, one of the biggest banks in the world. They were upside down. So, and then when Oprah and her friends on the West Coast that have, $800 million or whatever it was in, billions of dollars in Silicon Valley Bank, it's going to go poof. Hey, sorry guys. You should have been the venture capitalists who were concentrated on Silicon Valley Bank. Hey, you should have been more prudent with your, you take the cash in, you put it all in one bank. We told you, you're only guaranteed to $250,000 in an account. Zeroed out. Here's your $250,000 back. Call your investors and told them you were imprudent. So that was how, because of the fiscal dominance we're in, because of how the last 20 years have been handled, which is stock bubble, kicked upstairs to banking bubble, housing bubble, kicked upstairs to sovereign debt bubble. That was how the hard landing had to happen. And I said, go into this long-winded background context, because we saw in 3Q22, they wouldn't let the Treasury market break. We saw in 1Q23, BTFP, they're not going to let the Treasury market break. 3Q23, Starts to break again. They take action combined, Fed and Treasury, not going to let the Treasury market break. So back to the original question, are we going to have a recession? No, because they won't. The recession has, by virtue of how the last 25 years have been handled from policy, kicking it from stocks to banks, housing to Treasury and sovereign debt, they have to be willing to let the sovereign debt market, the Treasury market, break to have a recession. And they're not going to do that. They're not going to do that. They are going to, at any time, they will threaten and they will pretend and they will say we're going to fight inflation. They're not going to do that. And that's, I think, one of these sort of catalysts to go back to the original point of what's going to be the catalyst where people go, oh gosh, this isn't going to stop. And we're not there yet. The $6 trillion in money market funds, the overweight on long-term Treasury bonds is still like, oh, don't worry, the Fed's still operating like that 40 years, and unemployment and inflation. Hey, great. It's over. We're in a new regime. We're in a fiscal dominance regime. We can still have a recession, but that requires them to stand aside and watch the Treasury market break, which will break stocks, it will break housing, it will break the government, it will break everything all at once. And that's not a world I don't think any of us really want to see.
Yeah. And I imagine, too, because just how critically important the U.S. Treasury is why they also wouldn't.
Oh, it's
like on the global stage.
Oh, yeah. It's a new Great Depression. Like there's no longer, by virtue of the choices that the Fed and U.S. policymakers on the fiscal side have made over the last 20, 30 years, that means they have painted themselves into a corner of let the Treasury market break or don't let it break. If they refuse to let it break, then we're not going to have a recession. In fact, we're going to have persistently high inflation. We're going to have persistently high asset markets. We're going to have a persistently weaker dollar. And it will be, critically, it's not going to be sort of this glide path. It will be nonlinear at some point in terms of all of those directions. And the flip side is if they want to let the Treasury market fail, let it fail. And in that case, it's hard to overstate how catastrophic that is. It would be really, really bad for everything basically but gold. And I would argue Bitcoin and the dollar.
It also makes me wonder too, like in that scenario, higher assets, higher inflation, weaker dollar, wouldn't that just create even more of a wealth divide though? I imagine like some folks are going to get more hurt than others in this scenario.
Yes. And that's sort of, unfortunately, this is sort of in the cake at this point. Again, once you make the choices that they have made, dating back to 1971, really, when we went off the gold standard, which was sort of the choice. It was a choice in America at that point, and then accelerated by Volcker that, hey, we're going to choose to become an oligarchy, a financial oligarchy. That's what was chosen in 71 and 80, essentially. And so now, it's not necessarily going to be negative for working classes per se. If you have a mortgage, remember the Fed is not going to let Treasury markets price in the free market. Once you get real yields get to 5%, as we saw, they start to say, okay, that's enough. And so far, it hasn't been explicit yield curve control. But if it gets to that point, they will do it. They will. And so if you have a world where mortgages are at 4, 3, 5, 2, 1, whatever, and the average American wage is rising 10, 15, that's a debt jubilee for everybody in America who owns a house, owns a car, now, does that create problems down the road? Absolutely. But the key is that it starts to, at the end of the day, it's the debtors and the creditors. It's the people and the banks. And it's sort of what it's always been throughout history. And this inflation would be detrimental to the banks and the creditors and beneficial to the debtors and the people. And right now, the debtor, the biggest debtor of them all, is the guy who's spending $900 billion a year in military, the U.S. government. they're the most powerful entity in the whole thing. So it's really interesting to me is I routinely hear, well, you got to own the dollar, and the dollar only goes up because the U.S. is the most powerful country in the world. And there's still, I think, an underappreciation of well, yes, the U.S. is the most powerful country in the world. We do have this unbelievable military that essentially backs the dollar. And that most powerful country in the world desperately needs higher inflation, a weaker dollar. They need the banks to lose. They need the creditors to lose. They need the real value of their debt to go down. So it is, yes. Will there be people that get hurt? Yes. Will it be less than get hurt in the alternative, which is, hey, let's let the Treasury market break? Great. Every bank in the country, shut it down. Guess what they hold for their reserve assets? Treasuries. Well, they're upside down. Now they have bank runs. Okay, but we're not going to backstop that. Okay. I mean, it's literally the Great Depression. Close the banks. And so now the only people who win are people who own gold. Like I own gold. I love gold. I think gold does well here. Do I want that scenario to happen? No, because I'm going to need shotguns at least as much as I need gold. So it's that's kind of where we are in this whole thing. So it's, would I rather have what we had in the 80s and 90s of sort of this Goldilocks, low inflation, high employment? Absolutely. But that's not on the menu of choices anymore based on the choices we've made over the last 20, 30, 50 years.
Mm-hmm. Okay, I do want to hear more on gold and Bitcoin. They are popular subjects on this show. So can we hear more on your views there for those assets? And if you have any sort of, I don't know, like if you want to share like price targets or how you're thinking about those two in particular, can we hear that?
Absolutely. I like them both. I like gold. I like them both for a very simple reason, which is the reserve currency issuer of the world, the United States, cannot afford its debt unless real rates are sustainably negative by a lot. And in a sustained negative real rate world that most investors or many investors, judging by their holdings of cash and treasuries, still do not think is going to happen. I think it's a mathematical certainty it's going to happen. It's just a question of path. Gold and Bitcoin do really well in that world. And that's sort of the simples that I think case for both of them. The little bit more, I won't say interesting, but I think it is a little more interesting, I guess, which is that gold is coming back into the system as a neutral reserve asset at the central bank level and replacing Treasury bond. And we can see this is not speculation. This is not 2013, end of 2013, China says it's no longer in our interest to grow holdings of FX reserves. In other words, we're done buying Treasury bonds on that. 2014, global central bank holdings of Treasuries begin falling. And if we look back, it's now been 10 years. Global central banks in the last 10 years, global FX reserves are down $100 billion, 12 trillion, 11.9 trillion. Their holdings of gold are up $600 billion in the same time, $500 billion in the same time at market. U.S. debt in the same time is up $17 trillion, from $17 trillion to $34 trillion. So central banks have just stopped buying our debt. Instead, they're reserving gold. So there's a central bank bid for gold that really began 10 years ago. And oh, by the way, gold's nearly doubled in that time. That really didn't exist pre-2014. Central bank demand for gold was down basically every year for the prior 40 years, 30 years, prior 30 years, 35 years. That's the first sort of other interesting demand driver for gold. The next is from the BRICS. There's been a lot of discussion around what's the BRICS currency? What's the BRICS currency? Nobody trusts the BRICS. They're not going to trust each other's currency. Exactly. 100%. What are they using? They're using gold. They are trading in local currency, and they are net settling in gold. Settling in goods, net settling in gold. There was an article at the end of December in the Wall Street Journal that noted that 20% of physical oil volumes last year settled out, or were done outside the dollar last year. I've been talking about this a long time, but I'm as qualified as anybody to say like that was conspiracy theory 5-6 years ago. I know because people were actively telling me, serious people were telling me, Luke, you're a conspiracy theorist. Okay, I'm hearing it's happening. Nope, you're wrong. You're a conspiracy theorist. Okay. Here we now are in the Wall Street Journal, 20% of oil last year. Okay, what's it settling at? Again, goods. Look at what Russian and Chinese trade is doing. It is like this. And on net, gold. Well, the global oil market is 15 times the size of the global gold market in annual physical production terms. So if you just have a little bit of the oil market bidding for physical gold, the oil market is so much bigger, let alone if we throw the gas market and we throw in the copper market and we throw in sort of other things. So I think there is this net trade settlement asset role that is also coming back, that is a relentless grinding physical bid for gold that I think is really bullish for it. For Bitcoin, it's simpler. Bitcoin does a lot of the things that gold does better than gold does it, to be honest. It's a neutral reserve asset tied to energy. It's obviously much smaller. It's much more volatile, but it also has shown repeatedly, bubbles or tulips, the tulip bubble went up, it came down, it was done. These bubbles, the famous bubbles that people want to compare Bitcoin to, up, down, done. When it goes down, back, new high, down, new high, down. That's not a bubble. That is a highly volatile neutral reserve asset telling you a currency is in the process of inflating away. It looks like the chart of gold in Weimar Germany. Bubble, 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 bubble. So I think, and that's not to say we're going to hyperinflate Weimar Germany, anything like that. My point is I think Bitcoin is a very elegant, very pure, it's the last functioning smoke alarm in terms of a monetary asset, neutral reserve asset, telling us what's happening to all fiat currencies out of necessity, out of fiscal dominance, out of what we were talking about earlier on in the show.
Yeah. Okay. So both have more upside from here. In terms of other assets that you're favoring, or even ones that you're maybe disfavoring or underweight, can you kind of give us a glimpse into like how you're thinking about where you want to be allocated in this kind of environment?
Yeah, I think I don't want to hold long-term treasuries. TLT, I think volatility is going to continue, so I wouldn't express that position as a pure short. I'd rather own puts on it. But and part of the reason is that I think where this all goes is yield curve control. Ultimately, the Fed is going to cap yields. They do not want to do that. That's the Hotel California of inflation, from which they can check out but never leave. But the point on that is that whenever they do that, I don't know where they're going to pin yields at. If they pin yields at 2 on the 10-year, TLT nominally is going to do just fine. It's going to go up a lot, quite frankly. However, it's a very suboptimal expression of what I see as highly likely to happen in terms of the end game from here, and even in the path, given where we are in the fiscal situation at the moment. So I would rather express that with Bitcoin. I'd rather express it with gold. I'd rather express it with equities. I do think I'd rather own industrials, both fundamentally and valuation-wise. I mean, I get the capital flow dynamics of why the Magnificent Seven, or whatever we're calling them now, are what they are, but you generally don't get paid that well owning stocks that expensive historically over time. So I'd rather own stocks, A, that are less expensive, but B, more importantly, we can clearly see an industrial policy dynamic afoot, started under Trump, has been picked up and accelerated under Biden, where we are reshoring, we are reinvesting, we are spending hundreds of billions of dollars in manufacturing capacity and bringing it back here. And I just think that I'd rather own cheaper stocks that more directly address that, particularly things like electrical infrastructure stocks. So I can't do names and tickers for compliance reasons, but it's things that sell into the electrical grid. I mean, I have conversations and I hear these incredible things around Luke, the government is mandating our state to be 40% electrical vehicle by 2028. Hey, great. Who can be against that? Next breath. Luke, the federal government is also mandating us to shut down 2 of our coal plants, without which our electrical grid will fail if we do a fraction of the target of electrical vehicles. So to me, and oh, by the way, a private equity deal I'm invested in electrical infrastructure equipment, the executives there say, Luke, the lead times for transformers are out 2 years. 2 years. So they're not going to get there, but the open field running for things like electrical infrastructure plays, industrial plays that sell into that, metal vendors, distributors, the open field running, when you talk to people in that business, they are very, very excited. They can't hire enough. They wish they had more capacity. So those types of things I'm really excited about as well from a productive industry and stock standpoint.
Yeah. Can I ask you one more question?
Sure.
Before I let you go. Okay.
Of course.
So just kind of framing up all of this, we're in this sovereign debt bubble and it is bursting. Is there anything that we could do to avoid this scenario playing out? Are we just too far gone? Is there anything that can rectify the situation, or is this just kind of how it's going to unfold?
There are some things. It's probably too far gone. We'll probably have to go through at least part of it, of either inflate or Great Depression, sustained inflation or Great Depression. If we have some sort of productivity miracle that is commercialized or implemented or comes to pass very quickly, then we don't necessarily need to go through either of those other 2 less pleasant choices. So if AI and AI robotics come out and are very productivity driving, then on one level, yes, it helps. But also you're going to be putting a lot of people out of work, and that creates, so that's why it's sort of in theory, but in practice, it probably wouldn't work well. Nuclear fusion or small modular nuclear reactors, fission reactors that could be commercialized and rolled out very quickly. That's the type of thing we're talking about. Fusion is the promise of the future 10 years from now, and it's been like that for 50 years. So who knows? The small modular reactors, they're making serious progress on. The challenge there is we're so far gone in where debt is, and interest doesn't sleep. And thanks to Fed raising rates to 5%, the interest that never sleeps is now compounding ever faster than it used to. When you read the stuff on small modular nuclear reactors, you're 5 years away, you're 3 years away, you're 7 years away from it really being commercialized. If that positively surprises, boom, that could be something that really is a game changer. Failing that, 3 years, 5 years, 7 years it's not going to be here soon enough. It'll help, it'll prevent a worst case scenario, cut off the far left tail. There's another way, it's very unpleasant, but if something, if you objectively as an analyst, I don't like thinking about this because it's unpleasant, but it's my job as an analyst to think about, okay, where could I be wrong? Objectively, if you look who holds the wealth of this country, it's overwhelmingly held by the silent generation that remain and the boomers. If something happens where, say there's 70 million boomers, I don't know how many, say there's 75, 80 million total between silent generation and boomers. If something happens where the sickest 40% don't make it out of 2024, 2025, something like that, their wealth, and they all has to be actually amongst the wealthier ones too, their wealth goes to their kids who are in their peak spending years. The liability associated, Medicare, Medicaid, go back to that true interest expense number. Right now, we're spending about $3.2 trillion per year. We're spending 11% of GDP per year. We're spending 70% of tax receipts per year, more than that really, on these entitlements. That liability drops meaningfully. The assets go to the kids who are spending a lot more. They have kids in college, they're buying their first or second houses, whatever. You get a GDP boost, you get a liability reduction, you get a massive productivity enhancement de facto. It's morbid as hell. But again, as an objective analyst, my job is not to consider how morbid something is, just the odds of it happening, watching for signs that it's happening and what the impacts would be. And the impact of that would be a massive productivity miracle, basically. So I watch for that. I'm not seeing that, but that's something else that could not just cut off that left tail, but be a massive productivity boom where we don't even have to go through, we wouldn't have to go through the sustained inflation I think we're going to have to go through.
Mm-hmm. Well, Luke, you've given us a lot to think about. I've really enjoyed learning from you. Can you let folks know where they can find you on social media? And also, if you have any parting thoughts, anything that you want to leave the audience to think about, please share.
So Twitter, let's do the easy part first. Twitter, it's at Luke Gromen, LukeGromen, all one word. If they're interested in more about our mass market or institutional research products, they can find out more at FFTT-LLC.com. And in terms of parting thoughts, I think it's important to I think the end game, we can see much more clearly. The path from here to there is likely to be very volatile. And so I think as people are trying to allocate their investments, think about how to manage their money and go through this volatility, I think it's really critical to stay unlevered. End of the day, it's pretty clear to me how this movie's going to end. I just don't know how we get from here to the ending. And I have a decent sense of how long it is, but I don't have a ton of conviction in how long it is in the path that will follow. And so the only way you get really, really hurt in that world as the average investor is by being levered. If you're unlevered, you can weather a lot more. So I would say that plus position sizing for the average investor is just so critical.
Well, Luke Gromen, founder of FFTT, thank you so much for being so generous with your time and your ideas. And I really appreciate you taking the time to come on.
Thanks for having me out. I was excited to be here. Really enjoyed talking with you, Julia.